Hello and welcome to AE Accounting Tutorials. We are beginning a new series on accounting equation. I'm treating this topic because of most beginners in accounting, and some of my viewers have requested for this topic to be treated. So if you are new to this channel, I will encourage you to subscribe to this channel, turn on your notification bell so that any moment I release any new video, you will get notified on your devices. Thank you. So when we talk of accounting equation, what does it mean? Accounting equation simply means the relationship between assets, capital, and liabilities of a business. Okay? So the financial relationship that exists between the total assets of a business and the total liability and capital of the business. So this accounting equation simply states that the total assets of a business is equal to capital plus liabilities of the business. Is that okay? And this accounting equation can be written in three different forms. That is, making this individual element the subject. So if total asset is equal to capital plus liability, then the capital can also be assets, total assets minus total liabilities. The same way we can make the liabilities the subject when you've been asked to calculate for liabilities. So liabilities is equal to total assets minus capital. So this accounting equation can be written in three different forms. But remember that this accounting equation is being invented by an Italian mathematician called Luca Pacioli. Okay? So Luca Pacioli. In the year 1494, this man is an Italian mathematician who invented this an accounting equation. Is that okay? So we'll be looking at the meaning or the detailed explanation of the individual elements of the accounting equation. That is the assets, capital, and liabilities. But before we look into details, I want you to get the gist of it by using two keywords to explain this concept for you. An asset, in simply terms, has to do with what a business owns. Okay, anything owned by a business has to do with the assets. So we have what the business owns is an asset. Is that okay? And the capital plus liability has to do with what the business owns. These are the two keywords. What the business owns is the assets, and what the business owns is the capital plus liabilities. Is that okay? This capital is what the business owes the owners of the business or the owner. So what the business owns, the owners or the owner, and the liability has to do with what the business owns to outsiders or third parties. Is that okay? So if the business owns any amount to third parties, that is a liabilities. And if the business owns any amount to the owner or owners of the business, that is what we call the capital of the business. So with this small explanation, we can say that without the business owing any amount to the outsiders, we can say that total asset is equal to capital. So if the owner decided to introduce $1,000 as capital into the business, okay, so capital becomes $1,000. We are saying that total asset is equal to capital when there is no liability. This happens because the money introduced is a cash, and cash is an example of asset, so it's equal to 1,000. But let's say that the owner wants to use this 1,000 capital to acquire a motor vehicle, which is also an asset, and the cost of the motor vehicle happens to be $1,200. This capital can't finance the motor vehicle, so the business has to go out to lend money to add up to the capital to buy this motor vehicle. So if the business goes out to third parties to lend money, let's say an amount of 200 cedis, then this 200 cedis becomes the liabilities. And the total of these two have to give us 1,200, being the cost of the motor vehicle as an asset. So in an examination, they can give you an information relating to liabilities and assets. They ask you to calculate the capital of the business. Is that okay? They can give you an information relating to capital and liability and ask you to determine the assets of the business. So I would like us to look into details of the meaning of these three keywords. If you're able to understand these three keywords, you will be able to solve any accounting equation question because they may give you different items. You need to know the classification. You need to know this item. Is it an asset, liability before you can compute for the accounting equation? Is that okay? So the first element we will take is the asset. Is that okay? So when we say asset, what is an asset? An asset is any economic resources that is owned by a business and then has the ability to provide future economic benefits to the business. So any economic resources that provides future economic benefits to the business or entity is what we call an asset. So if a business organization has a motor vehicle or building, and this motor vehicle has the ability to provide future economic benefit to the business or entity, then this motor vehicle will be considered as an asset. Is that okay? Very good. So this asset can be classified into two. So we have two broad classification of an asset. Okay. So we have the non-current asset. We have the non-current asset, okay, that is the NCA, okay, and then we have the current asset, that is the CA, okay. These are the two broad classification of assets. So when we say non-current asset, what does it mean? Okay, we have three different keywords that we can use to explain a non-current asset. A non-current asset are assets that are acquired not for resale, okay, and they are used to run the business operation, and hence they are always in the business for more than one accounting year. When we say one accounting year or one financial year, we are talking about 12 months, okay, that is 12 months. So any asset that is acquired not for resale, so one, not for resale, not for resale, and for running the business, and three, will be in the business for more than one financial year or accounting year is what we call a non-current asset. So any asset that is acquired not for resale and that is being used for running the business and then will be in the business for more than one financial year, we call those assets a non-current asset. Okay, so the difference between these two assets has to do with the intention of buying the assets. Okay, so let's talk about the current assets as well. So a current asset are assets that are used for the business operation. Okay, so assets that are used for business operations and can be easily converted into cash or liquidated into cash is what we call a current asset. And another name for a current asset is what we call a floating asset, because it is used for business operation, okay, and this particular asset can easily be converted into cash or liquidated into cash. Is that okay? So an example of this is what we call inventory. Okay, so what we have something we call inventory or stock. The inventories are the items that are acquired for the intention of reselling. If you acquired any item for the purpose of reselling, then that item should be considered as a current asset. Is that okay? And we also have maybe trade receivables. We have trade receivables, we have bank balance, We have the cash itself, cash or cash balance or cash in hand. But I want you to get this clear. Motor vehicle can be a non-current asset. Building can be a non-current asset. Furniture and fittings can be a non-current asset. Okay? So let's say a furniture or a motor vehicle can be a non-current asset. At the same time, a current asset. This is the reason. So if a business acquired a motor vehicle with the intention of not selling it to help the business to go on successfully, and it will be in the business for more than one financial year, and this particular motor vehicle be considered as a non-current asset. But if the same business acquired the same type of motor vehicle for the intention of reselling, or the business deal with the selling of motor vehicle, then that particular motor vehicle will be considered as a current asset because the business has an intention of reselling it, and that will be considered as an inventory or stock. Is that okay? Very good. So that is the meaning or the difference between the current assets and the non-current assets. And this non-current asset can be categorized into two. We have tangible non-current assets. We have the intangible non-current asset. So a tangible non-current asset has to do with the physical assets that can be seen and touched in the business. So any physical asset or any asset that has a physical substances that can be seen and touched in the business is what we call a tangible non-current asset. So for instance, and building, land and building, motor vehicle, furniture and fittings, we have plant and machinery. All these are tangible assets or physical assets that can be seen and touched in the business, and these are considered as a tangible non-current asset. We also have the intangible non-current assets. They are those assets that has no physical substances. They are not physical in nature. They cannot be seen and touched in the business. Example, we have goodwill, we have trademark, we have copyrights, we have so many things, patents, etc. All these examples are considered as intangible assets, intangible non-current assets, because they don't have any physical substances. They are not physical in nature and they cannot be seen and touched in the business. Because of this, they are considered as intangible non-current assets. But remember that the examples of a tangible non-current asset and the example of intangible non-current assets, they all come together to form an asset. Is that okay? So an example, if you see a goodwill and they ask you to write the accounting equation or determine a capital or anything else, you should know that the goodwill is part of an asset. That is why I take my time to explain this concept. Is that okay? All right, so we are done with the assets. Let's look at the other elements. But with the same asset, we have other classification as well. We have a floating asset, we have a wasting asset, we have a fictitious asset. All these are also another classes of assets. But for now, let's take with this and move to what a liability is. So the second element I would like to talk about is liabilities. What is a liabilities? Okay, liability simply means financial obligations that business has to pay to outsiders. Okay, any financial obligation or any amount that a business owns to outsiders is what we call liabilities. Is that okay? So any amount that business organization has to pay to outsiders, we consider that as a liabilities. So the liability is the right and claim that outsiders got on the assets of the business. Is that okay? Very good. This same liability can be classified into two. So for instance, when a business goes out to lend money of an amount of 1,000 to add up to his capital to acquire any asset, the amount of money lent from the outsiders, that amount is considered as a liabilities. And we have two broad classification of liabilities as well. We have what we call the non-current liabilities, the non-current liabilities, the same as long-term liabilities. Long-term liabilities, okay? Then we have a current liabilities. And it's also called a short-term liabilities. Okay, so that is a non-current liabilities, and we have a current liabilities. So there is a huge difference between these two. Okay, so when we say a non-current liabilities, they are debts or liabilities that are expected to be paid more than one financial year. Okay, so any amount owed to outsiders that the business supposed to pay for more than one financial year, we consider those debts as a non-current liabilities. Okay, so if a business owns, let's say, $1,000 to an outsider, and there is an agreement that this 1,000 will be paid in, let's say, 10 years or 5 years, because it is more than one accounting period, then we consider that as a non-current liabilities. I said it, one financial year has to do with 12 months. Is that okay? So example of this non-current asset could be a long-term loan, a debenture, bond, and those items. They are more. Very good. So we have current liabilities as well. Another name for current liabilities is short-term liabilities. As I explained this concept, as they are liabilities that are expected to be paid for more than one accounting year. This means they are of long duration or long period. That is why we say long-term liabilities. So as the name suggests, a short-term liability means they are debts or liabilities that are paid within one financial year. So if a business entity owns an amount to outsider, let's say $500, and this amount will be paid within the accounting period, then this will also, or it can be considered as a current liabilities. So some examples of these current liabilities are trade creditors, bill payables, we have short-term loans, we have expenses owings, we have income prepaid. All these are examples of a current liabilities. I mention of loan as a non-current, at the same time a current liabilities. If the loan will be paid for more than one accounting period, we consider the loan as a non-current asset. But if the loan is supposed to be paid within one financial year, we consider as a current liabilities. So I mentioned loan as an example of non-current liabilities and at the same time a current liabilities. So if the loan supposed to be paid for more than one accounting period, we consider it as a non-current liabilities. But if there is an agreement for the loan to be paid within the accounting period or within one financial year, we consider it as a current liabilities. So it depends on the time period. Okay, so anything beyond one accounting period, any debt beyond one accounting period is a non-current liabilities. A debt within one accounting period is a current liabilities. Is that okay? So I just want you to know the difference so that when you are preparing or you've been asked to determine the accounting equation, you should know how to go by it. Is that okay? This accounting equation is the summarized form of the statement of financial position or the balance sheet. Is that okay? But then it is prudent to understand this concept very well. So let's look at the third item being capital. Is that okay? So what is capital? Capital has to do with any amount of money supplied in a business by its owners to run the business or to grow the business or to build the business is what we call a capital. So any amount of money supplied into a business by the owners is what we call a capital. Okay, or you can say that it is the financial obligations that the business has to its owners. Okay, the financial obligations that the business has to its owners. Is that okay? So that is simply the meaning of capital. So any amount of money that is being supplied into the business by the owners is what we call capital. But with the preparation of or with the calculation of the accounting equation, there are certain adjustments that can be made on capital. Is that okay? So when we have, let's say, capital, let's say we have capital to be this in the question, then the owner of the business make drawings. Is that okay? Drawings can be either a stock drawings or cash drawings. So if the owner makes drawings for his or her personal use, it should be subtracted from the capital. Is that okay? So if there is drawings, we should subtract it from the capital. Okay, and at the end of the period, if there is a net profit, okay, this net profit we will explain into details another time, but just understand that if there is net profit that is ascertained at the end of the period, then the net profit should be added. Net profit should be added to get the final or the net capital that you use in your calculation. But remember, if this happens to be a net loss, then we subtract. Is that okay? But if it is a net profit, we add. So there are some adjustments that will be made on capital. For instance, if you have been given a several items to determine your assets by using the accounting equation, it will give you maybe capital, drawings, and net profit. You need to do this adjustment to get a net capital before you can consider that as a capital to do your adjustment. Is that okay? So we have three different basic forms of capital. Okay, we have what we call working capital. So we have what we call working capital. So what is the meaning of working capital? It is the amount of capital that is being used to run the day-to-day activities of the business. In other words, it is the excess of the current assets of the business over its current liabilities. So I will say that current assets minus the current liabilities is equal to working capital. In simple terms. Is that okay? We have another form of capital as well. We have what we call a capital employed. The capital employed in the business is also another form of capital. And this is the excess of the total assets of the business over its current liabilities. Is that okay? So when we have the non-current assets plus the current asset, we add them together, then we subtract our current liabilities. The answer is the capital employed. So we can say that the excess of the total assets of the business over its current liabilities is what we call a capital employed. By this time, I expect you to know what a current liability is, what a current asset is, what a non-current asset is. And we also have another capital as well. That is owner's equity. Owner's equity, okay? Owner's equity has to do with the excess of the total asset of the business over its total liabilities. So we know that our total asset is a non-current asset plus the current asset into brackets minus the non-current liability plus the current liabilities. So the excess of the current or the excess of the total asset of the business over its total liability is what we call the owner's equity. Is that okay? Very good. But let me still come back to the working capital. We are saying that the excess of the current asset over the current liability is a working capital. That is the amount of money the business uses to run the day-to-day activities of the business. But this means the answer will always be positive. But in other words, when the current liability exceeds the current assets, then we have something we call overtrading. Okay, it is a term used in accounting when the current as when the current liability exceeds the current asset. That is overtrading, but it doesn't normally happen. So the excess of the current assets over the current liability is what we call a working capital. So I think with the explanation of these three key terms, that is the assets, capital, and liabilities, any accounting equation question, you should be able to solve it. But remember that the owner's equity is the same as the net worth of the business. Is that okay? So after understanding these three elements, you should be able to solve any accounting equation question. Is that okay? As I said it earlier on, this accounting equation which states that total assets of a business is equal to capital plus liability, it is the summarized form of the balance sheet. So someone will say the balance sheet equation. Okay, so the summarized form of the balance sheet or the statement of financial position is the accounting equation. So if you really understand this, it will be very easy for you to prepare your balance sheet or statement of financial position. Okay, we have the format of the statement of financial position, and the link will be dropped in the description below. You can go and watch it to enhance your understanding. Okay, so I think we will end our lesson here. In our next meeting, we may take a question or pick a different topic to look at. Okay, make sure you subscribe to this channel. Okay, until we meet for our next video, I think it is bye for now.